A new dollar stablecoin called Open USD was announced with more than 140 companies around it. Names like Visa, MasterCard, Stripe, Coinbase, BlackRock, BNY, Shopify, Google, and many others appeared on the partner list. But the important question is not, do we really need another token worth $1? The better question is, who gets paid when that $1 token becomes the payment rail? That is the real story behind Open USD, also called OUSD. It is not just about making a coin that tracks the dollar. It is about changing the stablecoin business model. Today, the company that issues a stablecoin often keeps most of the interest earned on the cash and treasury bills backing it. OpenUSD says it wants to share most of those reserve economics with the businesses that help distribute and use the coin. So if you are new to stablecoins, this is a useful moment, because OpenUSD is a headline, but it also explains how the whole stablecoin race actually works. Start with the simple version. A dollar stablecoin is a crypto token designed to stay close to $1. If you have 100 tokens, the idea is that you should be able to treat them like $100 inside supported apps, exchanges, wallets, or payment systems. That does not mean it is the same thing as a dollar in a bank account. It is a token on a blockchain. You can send it to another wallet. A smart contract can receive it. A trading venue can settle with it. A business can use it as a bridge between countries, platforms, or currencies. For a company, the attraction is not usually speculation. A merchant, payroll app, exchange, or remittance company does not need a dollar stablecoin because it wants the price to moon. It needs something boring. It wants a dollar-like unit that can move quickly, settle outside normal banking hours, and connect to software. Imagine a marketplace that pays sellers in many countries. Traditional money movement can involve banks, card networks, local processors, cutoff times, and reconciliation work. A stablecoin can act like a shared digital balance sheet. One party sends tokens, the other party receives tokens. The blockchain records the movement. The companies still need compliance, custody, fraud controls, and local payout rails, but the settlement layer can become more programmable. Now, here's the part many beginners miss. A stablecoin is not only a technology product, it is also a financial business. In the typical issuer-led model, a customer gives dollars to a stablecoin issuer or an approved partner. The issuer creates or mints new tokens. Those tokens go to the customer's wallet or exchange account. Behind the scenes, the issuer holds reserves, often cash, bank deposits, treasury bills, or similar short-term assets, depending on the coin and the rules it follows. If the customer wants dollars back, the process runs in reverse. The customer redeems the tokens, the issuer destroys or burns the tokens, then dollars are sent out through the banking system. The stablecoin should be backed so that every token has assets behind it, but the assets do not just sit there doing nothing. Short-term U.S. government debt can earn interest. When interest rates are meaningful, that reserve income can become the biggest part of the business. That is why stablecoins can be extremely valuable even when the token price stays at $1. The issuer may earn income on billions of dollars of reserves. The user sees a stable token. The issuer sees a large pool of assets that can generate yield. There can also be minting fees, redemption fees, spread, custody fees, or fees charged through distribution partners. The exact model depends on the issuer and customer type. A large institution may have a direct relationship. A normal retail user may only interact through an exchange, wallet, or app. If this kind of practical crypto breakdown is helpful, subscribe to the channel. We focus on what the technology actually does, who controls what, and where the hidden incentives are, without turning every topic into a price prediction. Now let's bring OpenUSD back in. Open Standard publicly introduced OpenUSD on June 30, 2026. The project describes it as a shared stablecoin for global financial activity, operated by an independent company called Open Standard. Its pitch has three big pieces. First, businesses can mint and redeem OUSD with no fees, even at scale. Second, most of the earnings from the reserves are meant to go back to the participating businesses that adopt and distribute OUSD, after a small management fee. Third, governance is supposed to be collaborative, with Open Standard having its own management and a board made up of partners. That sounds technical, but the business logic is simple. In the old model, if a payment company sends lots of volume through somebody else's stablecoin, the payment company helps that stablecoin grow, but the issuer may capture much of the reserve income. OpenUSD is saying, if you help create the network, you should share in the economics of the network. It is a little like a highway. One company could own the highway, charge for access, and keep the tolls. Or a group of businesses that depend on the highway could help create a common route and share the benefits of traffic flowing over it. This is why the partner list matters. Not because every logo guarantees success. A partner list is not the same as real usage. But stablecoins have a network problem. A payment token is more useful when more exchanges, wallets, banks, merchants, processors, and apps accept it. If a merchant can receive OUSD, an exchange can trade it, a wallet can store it, a bank can help redeem it, and a payment company can settle with it, then the token becomes more useful as infrastructure. If those integrations never become deep or active, then it is mostly an announcement. That distinction is important. Some online reactions make Open USD sound like 140 companies all launched one coin together. A more careful reading is that Open Standard announced the stablecoin, and many companies signed up as partners or participants. Some may integrate it heavily, some may explore it, some may support it in specific products. The actual impact depends on what goes live later, where it is available, which chains support it, how redemptions work, and how much real payment volume uses it. So why would large payment and crypto firms want a common stablecoin instead of each company launching its own? Because money is more useful when it is widely accepted. If every payment company creates a separate private dollar token, the market becomes fragmented. One app uses token A, another exchange uses token B, a merchant receives token C. Then businesses need conversion, liquidity, custody support, risk review, and legal work for each one. A shared stablecoin can reduce that fragmentation. It gives businesses one dollar-like asset to integrate, one reserve model to review, and one governance system to influence. That does not make it risk-free, but it can be more practical than 100 separate corporate coins. There is also a defensive reason. Stablecoins are becoming a control point in payments. If one issuer dominates, it can influence fees, product roadmaps, chain support, access rules, and the economics around reserves. Payment companies and platforms may not want to build their future rails on infrastructure controlled by a single outside issuer. OpenUSD's promise is neutrality. The idea is that no single company controls the roadmap for everyone else. The partners get a seat at the table. The economics are aligned with adoption. The token becomes shared infrastructure rather than a private product. But this is where beginners should slow down. Shared governance does not magically remove stablecoin risk. The first risk is reserve risk. A stablecoin is only as reliable as the assets backing it, the legal structure around those assets, and the transparency users get. Saying a coin is backed by reserves is not the same as showing, regularly and clearly, what those reserves are, where they are held, how liquid they are, and who has a claim on them during stress. The second risk is redemption access. A token can trade at $1 on a good day because the market believes it can be redeemed for $1. But not every holder always has direct redemption rights. Retail users often depend on exchanges or apps. If liquidity is thin, if an exchange pauses withdrawals, or if direct redemption is limited to approved businesses, the experience can be very different from holding cash in a bank account. The third risk is regulatory risk. Stablecoins sit between crypto, banking, securities rules, payments rules, sanctions compliance, and consumer protection. A coin built for businesses may have strict onboarding and controls. That can make institutions more comfortable, but it can also limit who can use it, where it can be used, and how quickly it can expand. The fourth risk is chain and integration risk. A stablecoin does not float in the air. It lives on blockchains and inside apps. If it is issued on multiple chains, users need to know which version they hold. Bridges, wrappers, smart contracts, wallets, and exchanges can all introduce failure points. Sending the right token to the wrong network can still create a mess. The fifth risk is adoption uncertainty. A giant partner list can create attention, but payment behavior changes slowly. Businesses must integrate systems, train compliance teams, manage liquidity, support customer flows, and decide whether OUSD is better than existing options like USDC, USDT, bank rails, card settlement, or other stablecoin networks. There is one more misunderstanding to avoid. Sharing reserve economics with partners does not automatically mean ordinary users receive yield. In many jurisdictions, paying yield on a dollar token can trigger extra legal and regulatory issues. OpenUSD's current pitch is aimed at businesses that adopt and distribute the stablecoin. The user may benefit indirectly through better products, cheaper payments, or faster settlement, but that is different from being promised interest. So why are people talking about OpenUSD? Because it reframes the stablecoin race. For years, the obvious question was, which stablecoin is biggest? Now the deeper question is, who owns the payment network built on top of stablecoins, and who captures the income from the reserves? OpenUSD is trying to answer that with a consortium model. It wants the companies that create usage to share governance and economics. That is a serious idea, especially in payments, where trust and distribution matter as much as code. But the open questions are just as serious. We still need to see the final reserve disclosures, the exact redemption structure, the live chain deployments, the compliance model, the real governance process, and whether partners actually route meaningful volume through it. The safest way to understand Open USD is this. It is a planned, business-focused dollar stablecoin announced with a very large partner network designed to make stablecoin infrastructure feel less like a single issuer's product and more like a shared payment rail. If it works, the important change may not be that a new token exists. The important change may be that stablecoin revenue and control become something major platforms negotiate together. And if it does not work, the lesson is still useful. Stablecoins are not just digital dollars. They are bundles of reserves, redemption promises, distribution deals, governance choices, legal constraints, and technical integrations. That is why a $1 token can become one of the biggest strategic fights in finance. If you have questions about Open USD, stablecoin reserves, or how minting and redemption actually work, drop them in the comments. And if there is another crypto topic you want explained without the hype, suggest it below.